ultimately we'll edit it. I got intern who will help with that, and we're just going to kind of cut it into those bite-sized pieces to post out, and I'll tag you if
Wonderful.
you're cool with that. Um,
Yep.
so, all right, awesome. Um, so Trace, my first question for you, I'm going to dive right in since we kind of chop it that way. And I'm going to ask this first question purposefully embracing hindsight. How would you define and summarize the venture capital, I'll use the word zeitgeist in the 2010s in particular, and contrasting that to even some of the earlier periods, 2000s, 90s, a little bit before our time, but we've got some recollection there.
Diligence. That would be my major word. So I started my first company in 2007, 8, brand yourself at Syracuse. And to do the business plan competitions, I have a binder somewhere, a 45-page business plan. And that was necessary. Yeah, you laugh because that was what was necessary. And that was what was expected, where venture capital really was a risky asset, still is risky, but we had to do a lot of the actual work before we went out to raise capital. And this was 2007, 8. I majored in entrepreneurship, which no one actually knew what that meant. And people asked not tough questions, but real questions. And not to say that we don't do it now, but there was time to invest. We would meet with an angel, high net worth, family office, investor, institution, and it would be a 3-month process, which is what you would kind of expect. That's how it was done. And that basically went through, I would say, up until 2015, 16. And then people kind of got wind of this. Ooh, a Facebook IPO, lots of new millionaires. Ooh, a Shark Tank, I can start a company. It really became faux pas where everyone could be an entrepreneur. And just because you sell a widget, you're a tech startup. So that is, I think, some of the essence that we lost, especially in the last few years, where we've had record numbers. You look at all the stats, where we've had, I don't know, $200 billion raised just this year. And this is the year that we're in the downturn, because it was all kind of raised in the last year or so. But it got crazy last year. And that's what we can kind of point to, I think, where we had an existential crisis that everybody was investing in everything without diligence. I would get deals saying it's closing tomorrow. I'm like, okay, good for you. I can't do that. I can invest really fast. And I've done it after a phone call or on a phone call, or I've invested months later after doing diligence, looking at the industry, seeing some other companies and getting to know the founder, doing a little bit of a dance. And we lost that last year. We all know it. We got irrational exuberance. Stocks, IPOs, SPACs, ICOs, crypto. It just got perverse. And now we're seeing what happens when you have too much, too fast, and people coming into the industry who don't know what they're doing. Even SoftBank, Masa's son, just admitted yesterday in an interview, even he got exuberant with $100 billion. They took a $23 billion loss, the largest loss of any company in history, I believe, because he got exuberant. And he started the trend when he raised his first fund, bragging that he raised $45 billion in 45 minutes. When that's what you start bragging about, that's when you know that we are starting to have a problem and people are doing less diligence. So as my father and I like to say, we're investors together. There's what people call due diligence, DUE, diligence, but that's more of the private equity hedge funds word. We call it due diligence, DO, actually do the diligence. And so that's what we lost a lot of. And so now we're telling all of our founders and friends, okay, we're going back to basics, which is, going back to fundamentals, not growth at all costs, even though a lot of people made a lot of money. And it's going to take some time to kind of get a little bit more rational and practical.
Interesting. I mean, a quick follow-up to that, too. From my own experience, there was especially that time, what you mentioned, sort of that 2016-ish to 2020, it seemed like people were embracing I'll call it the shotgun approach, the odds, saying, well, you just need to have 100 bets. It seemed like that seemed to become the holy grail. And I wonder do you think any of that was in the pull against diligence? Do you see those as being at all fighting against each other? Do you know what I mean?
Yeah, so a little bit, because the traditional VC, they raise a fund and they deploy it over 3 to 4 years. Some funds do 3 to 4 investments a year. They write a bigger check, they're involved, they take board seats. And we're an investor, an LP in 3 emerging manager funds that invested in 30 to 50 companies, whatever allocation they could get, 50 to 250. So the kind of VC speak is the 100 investments is called like the Monte Carlo. You
Right.
have to invest in a lot of companies, and the idea is that you'll have an outsized return. So if you make 100 investments, if one hits 100x, you only break even, maybe at best. You need to have that 1000x, and then you'll just 10x, right? From that perspective, it's kind of weird. But when I invest in a company, I want 10 to 20 times my money back minimum. And so someone's like, oh, it's an easier, safer bet. There's nothing safe and easy. So I have friends who are investing at 30 or 40 million valuations at pre-seed, seed, pre-prod, pre-revenue. They say it's a safer bet. It's a top VC investing, and it's very high up, like media or finance or whatever industry executive. So they have an unfair advantage. They are de facto experts, which, I don't get the opportunity to invest in those founders because I only invest less than 10 million. Can you quantify what that risk is? Not really. It's a difference of maybe 1% of companies succeed. Maybe they're at 2, so that's half the risk, but still 2 out of 100. So it was a way of saying, look, we are going to invest in a lot of companies, and then we'll double down on the ones that work. So the fund that comes to mind that seems to be doing it well is Hustle Fund. They will put in 25,000, now I think 50 or more, into hundreds of companies. And my friend Will works there, and he's just an Excel savant, and he did a whole Monte Carlo, built out this model that financially works. I hope that they succeed, and they've raised multiple funds. Elizabeth and the team there are amazing, and they're kind of the exact opposite of a traditional VC fund. And I say traditional, what we were saying, like 2010 to 2016, before it got a little crazy,
Mhm.
where like a Sequoia and Andreessen probably make, I don't know, 100 investments a year. And that's also including like their $5 million bets at pre-seed seed, which they don't really care about. They're doing the Monte Carlo. They can write a $500 million check, or they can write a $5 million check, and they're kind of just buying lotto tickets sometimes. And a lot of these early funds who write these small checks, they'll save some money for follow-on to keep betting on your winners, kind of like blackjack, double down, or they'll do SPVs and just keep raising outside capital.
Wow. So that actually is a good trend, good segue, excuse me, to my next question, which is, okay, so given what we've seen now in this past year, and understanding I'm asking this question in August 2022 here, so it's contextual. From a short-term perspective, how are you seeing founders and investors reacting to all of that? Especially considering companies that may have been wanting to raise capital and are running shorter runway, and now recognizing, oh, not a great time. How's that playing out?
Personally, professionally, we've made 1 investment this year. So we made 12 last year with 5 follow-on, which was our most active year, about 1 a month, or we did 2 or 3 in 1 month and kind of spread out. And then our companies raised additional capital. And we, made 17 investments overall last year. This year, I'm in support mode for a few reasons. Basically, I have some companies, my best performing companies are cash flush. They raised a lot of money last year, and they have been controlling their burn, where they have about at least 24 months. And that's before they kind of cut back a little bit, because generally you would raise every year or so, depending on what your traction is. From an investor perspective with my friends, a lot of them have stopped, or at least slowed down significantly, because people ask what my job is. One of my roles is to invest in companies that will raise more capital. Stop. Right? I'm supposed to invest in profitable, growthable, scalable companies, but I'm in the round that's 500 to 2 million. You're not going to become a unicorn with just that capital, and you're not going to be able to cheat time if you don't raise more capital. And so once the stock market dropped, that basically cut multiples at least in half. So growth stage, pre-IPO, froze over.
Oh.
Then below them, the Series A, B investors stopped because there was no more capital above them. And so it's like a domino effect. At pre-seed and seed, I'm still seeing a lot of investments because it's still very risky. And when they raise capital from us, they'll get 12 months, 18 months, which is what we think this weird time will take. Like right now, it's survival mode. And so my job is to invest in companies that my friends at the Series A will invest in. I've spoken to 2 today, and they're like, we're looking for this and this. So I keep tabs on what the next round's looking for, because I'm basically a scout where I invest in companies. I have my own little niche. So I'm opportunistic, no fintech, biohealth, education, insurance, and a whole host of other things I don't like. A lot of B2B SaaS, enterprise, deep tech. So I know a lot of the investors in the space. They tell me what they're looking for, and then I try to invest in them here. And hopefully in the year, they'll hopefully meet my friends' standards. And also hopefully their posts haven't moved. That's the game that I play. And it's been difficult to kind of predict the future lately.
That's interesting. It's an interesting perspective, because you hear most early stage investors, ironically, are almost trying to predict the end result. And what you're basically saying is, I'm going to embrace the fact that I'm just sort of the first step on the ladder, and just trying to get them to the second run, and let them run from there, and maximize for that, or optimize for that. Is that?
Yeah, that's what I have to tell my founders. And so they're in hectic mode because so many companies are laying off. They're cutting back their budgets, and they're just trying to increase runway. So I had, 6 companies last year, towards the end of last year, raised 10 to 30 million. So they're good. They've managed burn. But a few of my pre-seed seed who've only raised 500 to 2 million, they're in a tough spot where they can't raise additional capital because they haven't hit enough metrics. Expectations have gone up, and they have to kind of cut back on budget. So they have less to spend. It's kind of a catch-22, but they have to burn to get to some type of growth, which they normally would have to do organic plus paid events and other means. So it's a difficult spot. So that's where I am in support mode. Marriage counseling as well with my founders who had it easier with a lot of money going around. Even though if you follow like Shai Goldman, formerly SVB, now at Brex, he has this updated list of funds over 200 million. Just this year alone, I think 200 billion was raised to some extent, but there's dozens of firms over 200 million with fresh capital to deploy. They probably don't want to do a capital call now to some extent because their LPs are either cash strapped because they're coming back a year after their last capital call fundraise. So that's where it's getting a little murky, where my friends and funds are deploying in 1 to 2 years, which should have been really 3 to 4 years. So they're going back to the money pit in half the time.
Wow. How do you think that's going to play out? If they're holding off now, I mean, that's going to crunch them later down the road, right? I mean, no free lunch. Meaning, if you're going to invest 4 years and you're holding off for 1, now you only got 3 years to deploy it, right? I mean, that's.
So it's definitely going to be a crunch that we're going to see, and everything in the markets, right? So like lumber went right up, oil went right up, copper went up. It's all coming down. People are finicky and emotional, and so we saw this, like COVID hit, every stock went up, and they're like, oh, okay, COVID's over, done. We got irrational to some extent, and also we thought e-commerce and all these multiples would stay, and then we're like, actually, it's kind of getting a little bit back to normal. We saw what broke, we pushed everything to the extreme, and so a lot of wealth was created and then disappeared. So these LPs are like, we didn't model for you to come back within 12 to 18 months. We were expecting 24 to 36 months to have a conversation.
Wow. Okay. Got it. Interesting. Yeah. It went in both ways too.
Yep.
So I'm curious, with all that, being said too, kind of the undertone and people's strategy, the hold off could be maybe 2 ways. It could be, all right, well, we're just trying to almost like wait out a period and then continue what we were doing. Or do you see people who are at all rethinking and saying, hey, maybe we should revisit some of the due diligence models that we were doing, as opposed to assuming things will be 2021 again when this is all over? Do you know what I mean?
All of the above. And so there's definitely a capital crunch. I still see a lot of deals get done at pre-seed and seed. A few of my companies are raising seed 2, seed plus, bridge to A, pre-series A, whatever you want to call it. And
Yeah.
those are the ones that have a little bit more traction. So we're seeing a flight to quality where a lot of companies are not getting the valuation that they would have last year, but they're getting either a flat round or a slight up round, a cap or a priced round, where in normal times they would be fine. And so they can raise another 1 to 3 million to give them the time they need, because they're on to something. Opposed to kind of, we just launched, we have some metrics, it's kind of getting there, but we need more time. A lot of these companies are going out, at least my portfolio companies, for like a Series A, and they got a few $1 million. They wanted probably 5 to 10, they got 2 to 5, and that's fine. That will give them the full year they need. They'll take some more dilution, which is unfortunate, but I'd rather have a piece of something than a piece of nothing, depending on where their metrics are. And so a lot of people are coming out of the woodwork to find these companies. So behind the scenes, a lot of VCs are just sharing what they can. If something picks, great, an introduction. I made hundreds of introductions over the last few months and helped raise hundreds of thousands, millions of dollars for my companies, because there's a lot of money out there. People still have a lot of money, whether it's a VC, just a random high net worth who made money outside of tech, who still wants to get into tech. We always joked, and everybody always told us, all the elder, wiser people in this industry, now is the best time to invest. It's always the best time to invest. If you find a good company, good metrics, good founders, invest.
And I like that perspective. You've heard that about even real estate markets and stuff like that, where they just say, stop trying to time it, just.
Right. I'm not trying to time stocks.
Yeah.
Like that. I've made some money, I've lost some money. Those are the fundamentals. And so you're saying diligence. Yeah, people are asking tougher questions. Before, I was laughed at some entrepreneurs to some extent. I was like, hey, what about this? And they're like, whatever, we'll talk about that, we'll figure it out later. I'm like, you probably should figure that out now. So I was like, great, I don't need to invest. And I passed on a lot of companies last year. We do early, less than 10 million valuations, which people laughed at me for. And that's fine. We do really, really early. And so last year, it was definitely difficult because every valuation was just being drawn up. People are fighting for rounds and allocations, but we still found 12 of them. They exist. You have to take a little bit more risk, and then you get the more reward. People ask, as I said before, my job is to find companies that can raise more capital, but it's also to make a lot of money. So if I invest at a 10 million valuation or 20 million valuation at $1 billion exit with 3 rounds and dilution, that's a difference of like 30 to 50x and maybe 15 to 25x.
Big difference.
Right. At $1 billion exit.
Yeah. My next, so I got another question, just sort of stepping back from that context for a minute to examine, because I was shocked. I just did some research on this, and I just realized that Mark Andreessen's famous "Software is Eating the World" post is now 10 years old, which is like crazy, because I remember when that came out and it was like the hot new thing. And so I was doing some reflection myself, and I'm curious if you agree or can comment on it. But it seemed like in the early days of that, there was this big focus on disruption, and that was when you saw, like, the Ubers of the world sort of coming out and really trying to truly reinvent models leveraging software. And then it seemed like, as things, even as weirdly as they got more exuberant, I found in the venture world, things were concentrating more and more on more proven models like B2B SaaS, and less on some of those bigger, higher risk types of models. I'm curious. First, I'm curious if you have, and use anecdotally, noticed the same. And further, if you want to comment on whether they should retool focus towards more innovation, or you like that focus. Like, what's your feel on that from as an investor?
2012 was an interesting time. So I graduated 2010 Syracuse. I had a PR agency, and around 12, started like a digital media company because media was kind of still hot, and I was running digital media analytics, and that was necessary because my first company, Brand Yourself, was teaching social media. 2012, still this new cool thing. And I totally agree that in 2012, software was eating the world. The iPhone had come out in 2008, 9, the App Store came out like 2009, 10, 11. And so we have now apps on our phone that can literally do anything. I can call a car. At this time, we were investors in Pinterest. That took off. I can pin, I can save anything. Twitter was becoming more prevalent. I've been on Twitter for 14 years. Facebook, around that time of their IPO, they were doing mobile advertising. Their stock after their IPO was flat and down for like a year because no one knew what this mobile advertising thing was. We always had like the Razor flip phone. So this revolutionized, and I don't use that word lightly, this changed the entire world. And so that's how you could have an Uber where software was eating the world. Otherwise, I had to call somebody and set it up and they would come. I give them cash or my credit card, they write it down. So that's where software ate the world. No question, that was a groundbreaking piece. But software eating the world doesn't mean it scales. It doesn't mean it's profitable. Uber, I think just in their last quarter, yes, they had a huge growth back from their downward spiral. That they were the first time they were free cash flow. I think they had $500 million free cash flow. And it's like, holy crap, that's amazing. We also know that they've never been profitable and they've lost about $45 billion, I believe, leading up into this point. So that's where I enjoy, and I would say half my investments have been B2B SaaS, because Uber is the exact consumerization. You're going after billions of users. That's how it scales. Facebook, Twitter, Pinterest, Uber, Lyft, that's the consumer model. You need hundreds of millions, billions of users. Users are annoying. So B2B is larger contracts. They're professionals. They generally have money, and you renew it. And they hopefully pay on time if all things are normal. Probably a longer sales cycle and higher like CAC to acquire them, but it's recurring revenue. That's a big problem with CPG and direct to consumer, which became very cool in the last few years. Every year you start at zero. With recurring revenue, I have MRR and ARR. So these are contracts you sign for hopefully 6 months a year, multiple year contracts, and it just keeps paying, kind of set it and forget it. And so it's just like stacking on top of each other, which is what we see a lot of the high growth public companies before the fall, even the ones that are still doing well, are SaaS. They basically sell, they keep stacking the revenue, it's predictable, and it doesn't just go away. So when COVID hit, Uber straight down, travel straight down. SaaS, okay, there's some hits, like a few companies went out of business, but people always need servers, they need their analytics. Look at AWS, look at Google Cloud, look at Microsoft Azure. Amazon is basically valued at AWS these days. Their Amazon shopping is almost valued at zero.
It's crazy, but makes sense. I based on what you're saying. I mean, the recurring revenue is huge. So how does that play? I guess as you're looking now into this, I mean, it's kind of crazy to say, looking into this next decade when we're really 2 and a bit years into it, but with the pandemic, it kind of changed things a bit. So it almost does feel fresh. But looking into this next sort of 10-year stretch, what do you think is going to be sort of the next frontier, so to speak, for venture world?
There's always frontier tech. I still enjoy my B2B SaaS. I have some investments in CPG, direct to consumer, that are doing fine, doing just great. Like my best investment is a smart dog collar. And he publicly just announced he's doing 50 million revenue in less than 5 years. Phenomenal. No one wanted to touch hardware CPG, and there's a SaaS component to it because you have to pay for the service. So there's always bets out there for hardware, which people are afraid of. It's always hard. There's always going to be CPG, consumer. Someone will always bet on it because they made their money there. They like it. It's kind of cool, sexy. I will probably more focus on B2B SaaS enterprise. And I want the frontier tech that you're discussing. So I have some machine vision, some AI, some machine learning. neural networks, just sprinkle all that jargon on there, some deep tech, because I think that's always going to stick around. I am looking for things that aren't recession proof, that always will be needed. Do I need another like drink, another alcohol, another food brand? No, someone will always fund those. There's always going to be like a media company. I'm not going to invest in anything media related. No ad tech. There's no true innovation there. Like Axios was just acquired for 525 million. There's always $1 to $2 billion or less ad tech media companies acquired. And so, yes, I would love some space investments, the final frontier. I want some climate investments because we have to save this planet of ours. I'm sure everyone else watching this, depending, it's August 9th, is schwitzing right now because it's 90 degrees and humid out. Is it global warming, global crisis? I'm trying to find some companies that are doing something innovative, either carbon capture, hopefully not doing carbon credits, which is kind of selling offsets so you can keep polluting. There's an inverse, I think, correlation there for like a business model that's not sustainable. But that's what I'm looking for. Some cybersecurity, as SaaS is taking over and servers and identities. We have to protect ourselves. Not everyone is tech literate. We've all fallen for scams. I am high tech, but still, like, we all fall for these issues. I'm not a big crypto bullish component of what's going on. I think a lot of it's starting to get flushed out. I've had some successful pivots into crypto, but I think, like a lot of industries, a lot of it is just uninvestable, but the technology is not going away. So we'll see where that plays out.
So is that sort of you want to be in on it selectively, but recognizing you want the core kind of to be that SaaS models? That's sort of the strategy to that.
That's what I'm looking for, but I've made investments. Sometimes you know it when you see it. So I know what I'm looking for, and I know exactly what I'm not looking for. So as I said, no fintech, bio, health, education. I have no expertise. My background's in media, PR, comms, business strategy, consulting. So I don't know banking. I don't know deep, like 8 layers of banking, processing of payments. Biohealth, I want nothing to do with FDA approval, HIPAA, health records of anybody, or hospitals, education. I'm not selling to college students. I'm not selling to colleges. I do not enjoy that. Insurance, we just found out there's nothing innovative there. It's just a new way of packaging it. And then I just don't enjoy dating apps. I met my wife on Hinge. I'll never invest in a dating app. I was an event tech for 5 years, so I'll never invest in events. So at least as an angel, I'm going to bring that into my fund and my thesis. It's easy when I say I know I don't invest in, and when I have my valuation constraint, nothing over 10 million, I can at least easily say no to 75% of what I see. And I just give a quick no to all the founders, which is what they want.
Yeah.
If it's not a yes.
Yeah. Quick no, move on. So I want to transition a little bit in terms of topic to geography for the last few questions I have. And now, correct me if I'm wrong. I mean, how much of your portfolio would you say is New York City based?
Less and less with every investment. So when I started in 2016, we kind of formalized our investments and call it New York Venture Partners. Why? I'm 34 years living in New York. I grew up Long Island, went to Syracuse City for 10 years, went to Columbia for business school, and now back on Long Island. So I'm a New Yorker. When everything, as we were discussing before this, was in person, yeah, my network was here. And that's where I met companies where you had to kind of be in proximity to them. So that is where a lot of our investments are from. Also, my father ran the New York Angels, and a lot of those companies were from New York. A lot came from out of town, or they kind of zoomed in. And I have spent the last few years building out my network to go beyond that. So we have investments in Seattle, in San Francisco, in LA, in Vegas, New Jersey, Maine, Florida, technically one in Copenhagen, but the US Delaware C Corp. We have a few that have like half their teams in Israel. And so proximity doesn't need to be face-to-face anymore. I still have only met half my investments in person that I made last year. and I'm trying to meet them in person. A lot of it can still be done over Zoom. So yeah, maybe 65% are in New York, but it's definitely not a requirement. I just need you to be a clean Delaware C Corp.
Wow. So it's, if I'm understanding correctly, it's mostly just been a consequence of how your network formed in close proximity in person.
Yep.
That continued, but are you agnostic? Could you use that term even to geography at this point, or do you have?
Yeah, I don't care where you're based. I would say a lot of it does come from major cities. It's something that we're trying to at least work on. Like just because you're based in like Raleigh, North Carolina, like Austin's up and coming, Miami is now up and coming, like boo Boston. I'm a New Yorker, so like if you're from Boston, don't pitch me. But San Francisco, the valuations were always higher, so it was a little bit more difficult to get those companies. LA was up and coming a few years ago, but there are what we call the second and third tier cities of tech, where there's just not as much capital and there's also not as much talent there that came from larger tech companies where they kind of fit that mold that unfortunately a lot of people are looking for.
Hmm. So I'm thinking about, so again, with the context of more good jobs, we're talking to startup community builders, typically outside of major hubs.
Yep.
And in those areas where you have these incomplete ecosystems, there's so many different elements to it, not just resources, but even cultural. So like a great example, even in Syracuse, for example, actually you guys face this head on with Brand Yourself. Doesn't mean that there isn't high net worth people here. It just means there isn't a culture of angel investing the same way there is, and thinking about
Agreed.
how that asset class is. So um, that always presents a challenge for entrepreneurs and community builders in those regions. Do you think the world has flattened a little bit to their advantage to some extent now, or give me your perspective on that?
Most definitely.
Hmm.
We can meet founders from anywhere, where if someone was coming from Syracuse, you'd be like, great, yeah, let me know when you're in town.
Yep.
If you're in a different city from New York, well, I only did New York initially. So like if you're in town, we'll meet up. So that just kills time. Now it's like, great, let's jump on a Zoom call next week or tomorrow. It's a little bit easier if you kind of pique my interest with what you're working on or your background is unique. And I just kind of want to learn more. Like I feel like there's something there and I just have to kind of scratch the itch. So everything is digital. I posted on Twitter, I don't know, yesterday or the day before, we invest in founders, pre-seed, seed, those who will figure it out. Iteration is the new innovation. I got maybe 400 messages. And these are people from all around the country and all around the world. The ones from all around the world, I just had to say thank you, but we only do US, but all around the country. And they just are looking for investors. Angels is a fancy term for high net worth individual or family office. A lot of people who consider themselves angels technically aren't, at least in the eyes of the SEC, or they are more transient angels. So you have to be careful also who you take money from, because Shark Tank is not real investing. They take like a significant chunk of your company. You want to take money out. So be careful who you raise money from. I know that you don't generally have the leverage, but try. Ask them questions. Where's your money come from? What's your background? What's your expertise? We've had founders in the past give us a survey of saying, how can you help me? Which is rare in the last few years. Is mostly like, give me your money. And like, if you can help, great. If not, don't annoy me.
Huh. That's interesting. What was your interpretation when they gave you that survey? Was that positive or negative?
Generally, it's positive, where they are trying to vet. If it's a
Yeah.
hot round that a lot of people want to get into, they can be selective if they're in that position of power, and they can pick and choose who can help them. So I generally like those founders. Sometimes it can be somewhat egotistical, like I don't need you. Whereas most of the time it's well-intentioned that they need my background, PR and comms. Very early on, a lot of founders take that for granted. Great, I can write a press release for you. And a lot of people think PR is just about getting media attention, but we ignore the hell out of our founders for every single word in their release, on their website, when they're talking to other people. What are their benefits? You can go in a diatribe of what your company does, but I get pitches from people and they send me paragraphs. I'm like, give me one sentence about what you do. That is very hard to do. Like when I learned with Brand Yourself and when I did PR, one of the hardest things to do is write about yourself and talk about yourself. It's awkward.
So do you get a lot of, I mean, you get a lot of inquiries, but is that a main source of deal flow now, sort of online, these pitches like that?
No,
Still intros through your network.
it's unfortunately, I would say, still 90% warm intros where they came from another angel that I know, whether it's a group of mine that I'm in, or they are co-investors of VC who are leading around and they know that I am a value add, they want me in. Or last year, 4 of my 12 new investments came from founders I've invested in. So founders go to other founders who've raised capital and they recommend me to be a hopeful value add investor in this company.
So, all right, so that's a good segue to my next question, again, regarding geography. So your response to sort of the being agnostic to geographies is something I've heard before, but the asterisk to that is a lot of the deal flow, again, like similarly, still comes from references. So if you are in wherever, somewhere middle America or whatever, what would be your recommendation, both the founders, now understanding, again, I'm going to preface the usual stuff, like, get your deal room together, blah, blah, blah. All right, table stakes. Beyond that, specifically relating to the network, what's your recommendation for someone there to find capital, early stage capital sources like you?
You have to network. It's the strongest way of doing it, unless you just have a ridiculously phenomenal background where like, okay, this seems like a diamond in the rough. And hopefully you can get some introduction to me. I know that that is not the best way and it kind of is a closed gate, but I have hundreds of connections and I have hundreds of investors that I work with. So hopefully you can get in front of me. It doesn't guarantee you even a meeting. People send me DMs, LinkedIn, like I look at the decks, I look at all of them, and I've taken a few meetings from it. And even if a VC or a founder sends me something, I'm just like, no, I have no interest. Like maybe like if you want like a favor, like I'll take a meeting, like maybe there's something there. But if it's not for me, I'm not going to waste anyone's time. So I get a lot of things like, hey, check this out. Like we're investing. I'm just like, I've seen a bunch of these. I've told my friends, like, I don't like what you invest in. You don't like what I invest in. We're making very binary bets and we each have our theses. We each see something different. So you have to network, write, do a newsletter, start a podcast, go to events. It's one of those things, like if you can't get an intro to me, like how are you ever going to sell? How are you going to hire? How are you going to build a product? It's one of those questions. Not that you can't, but it just brings up those questions. So I'll always say it's unfortunate, but that's the way the industry is. But fortunately, I'm one of thousands of investors. So if you can't get in touch with me, it's probably not the end of the world.
I like that. I like that response though, because it's a good point, which is, look, I mean, especially to embrace it. If you're going to view it as a connectivity disadvantage, well, then you're either going to overcome it or you're going to move. And if you can't overcome it to get investment, you're not going to overcome it to get customers. You're not going to overcome it to recruit talent. You're not going to overcome it for anything else. So somewhat of a natural
of the metaphor in there, right? So I can't dictate where you live. And if you really love this company and idea, maybe prior to COVID, when everything went digital, you really had to travel, conferences, meet people, and like make some type of blip on the radar.
Wow. Awesome. Thank you, Trace. This has been awesome, man. I really appreciate your time. Really interesting insights. Could have taken up way more of your time, even though I went over already, just on ask follow-on questions. So I really appreciate it. Like I said, we're gonna chop it up, and we'll post it. We'll definitely want to tag you. I definitely appreciate that. Hope I can pull some founders intro to on that front too, to get engaged. What, if anything, can I do to reciprocate the favor? Not to be transactional, but in a supportive.
All I ever ask for is introductions to great founders and smart people. That's exactly what the networking is. I just meet as many people as possible.
You got it, man. Couple I'm talking to, I might point your way at some point. So
yeah, just send me over the information. I'll preface, I'll probably say no. Unfortunately, I'm in the business of saying no also.
Makes sense. As you should be. I get it, man.
Yep.
Thanks
So
so
just
much.
let me know when it's ready, and I'll take a look at it.
Okay, cool. Well, best wishes on your move, and enjoy the weather in the coming months when it gets colder.
Yep. I'm looking forward to it. Thank you.
Cool, man. Take care.